Good morning, everyone, and welcome to the Ankerstar Wealth Morning Show. I'm your host, Allison Ankerstar, and today we'll be talking about today's Fed rate hike, tax loss harvesting, and the wash sale rule. But before we begin, as a reminder, this is a financial education presentation and should not be construed as personal financial advice. Full disclaimer information is available at ankerstarwealth.com. Good morning, Steve. The long-awaited Federal Reserve rate hike announcement is this afternoon. How do you expect the market to react?
Hey, good morning, everyone. Good morning, Allison. So yeah, during these rate hike weeks, that's all everybody talks about. And you'll notice there's a decrease in volume of trading, and pretty much the markets hang around the even area with unless there's some other catalyst that's bigger than the Fed rate reserve rate decision, which usually there isn't, right? So the week going into this, it's kind of muted, if you will. All that's the term they use there on CNBC. All the way until you get the announcement. There are some people that trade ahead of it, but I would say that's more of a trader's mentality than actually an investor's mentality, if you will. So again, expecting the 50 basis points for the rate hike today. That's been largely forecasted. So, excuse me. So as long as that happens, I expect everything to continue on normal. I think the markets will end up in the green today, once they see that that's actually happening. When you think about yesterday, though, excuse me, when you think about yesterday, we had the inflation number that was better than what was expected, and then the market celebrated that. The markets were up, 3% plus, at least for the NASDAQ, right around that opening time frame, and pretty much sold off all day. So there was the, exuberance, if you will, of, hey, inflation is now starting on a downtrend, or at least lower than expected, if you will. Today, rate hikes are supposed to be starting down, going from 75 basis points to 50 basis points. So overall, things are trending in the right direction, but I think it's largely a wait and see type day until 1 o'clock Central this afternoon.
Next, tax loss harvesting is a great strategy to save in taxes. Can you explain how it works and how to take advantage of it?
Yeah, you bet. So tax loss harvesting at its core is a good strategy to take advantage of losses. And you're like, what? I don't want losses. So let's not take advantage of them, right? So I get it. You invest to make money over time, period, dot. However, during that journey, you will have losses along the way. If they're in retirement accounts or 401ks or anything like that, this does not apply, right? Because you're not paying taxes on that money. You've either in a Roth IRA or Roth 401k already paid the taxes, and now it grows tax-free, or in a regular IRA, you're deferring those taxes until you sell later on. So we're only talking about taxable accounts here. So don't get crazy. Make sure you know which accounts you're in when you go to apply this strategy. But in a taxable account, the money that you're making is taxed, right? So if you have a great year, let's talk about like every other year but this one, you at the end of the year, you have a tax bill, right? And you get favorable capital gains, get favorable tax status. You have long-term gains. You have short-term gains, which are taxed as income. You have some other, different levels depending on what sort of dividends, as well as qualified business deduction. There's all kinds of different layers out there, but all in all, if you make money, you're going to be taxed on it. So the reason this is in the tax code is for those years that you lose money, or if you have a loser along the way of making money, you're allowed to offset the gains 1-for-1 with your losses, with an exception, and I'll get to that. So when you look at it, it's selling of securities. And this is, why do we bring it up at the end of the year? So, at the end of the year, you look to see if you have a required minimum distribution. That's kind of number one. Then you look at, are there any losses you can harvest out of your portfolio? Largely, we've done this. So, if you're with me, you look through your portfolio and you see some losses in there. Well, we're not going to sell everything that's down, because you know what? A lot of things are down. We've harvested what we could. We may do a little bit more, but not a tremendous amount. So when you sell something at a loss, again, you offset it 1-for-1 from your gains. Well, what happens in a year like this year where there are either no or very little gains, right? So in that case, say at the end of a year, you have 30,000 in capital losses. Well, you can offset gains if you have them up to 3,000, and offset regular income up to 3,000. And after that, you're going to take the other 27,000 and carry it forward. So it's a, loss carryover, I think is the exact term that the IRS uses here. Yeah, capital loss carryover. So that means you'll have it, in the bank for next year. So in 2023, it's assuming that's an up year and you have capital gains. It'll offset one for one all the capital gains that you have, and then an additional 3,000 per year against your income, right? So you get a little bit of a break. Now, things that well, let's talk about the key takeaways. I'll talk about some examples here. Reduce the total amount of taxes. Yes. Selling at a loss. We'll talk wash sale here in a second. Okay. So the anytime you do this, you don't want to upset your portfolio, though. So portfolios are designed, for a reason, and they have different goals and have different weightings and different exposures to, the world, as well as different sectors, different risk levels. If you're with us, so when you go to sell something, that immediately changes the balance of your portfolio. So then you have to look about what other changes you need to make to your portfolio. Maybe you buy something else that's different to improve the portfolio. Or if you're looking at buying something that's very similar to keep the portfolio in balance, we'll talk about this here in a second. But each year, when you look at your portfolio towards the end of the year, if you have losses, you may consider taking them. Last thing I'll close with on this is if you have one of those stocks that maybe you took a flyer on years ago that went from $100 and it's now down at 8 cents, don't forget. A lot of people keep those in a portfolio forever. Don't forget that when you sell those, you get to take all of those losses. So whatever you lost on that great idea that you had, you get to write that off. But you don't get to write it off if you never sell it, right? So there is a time to go through your portfolio and kind of clean out the trash, if you will, take out the trash. So if you have those long-term holds, again with those huge losses, don't forget you can sell those and get credit for them.
Last, the wash sale rule means you can't sell a stock and buy a substantially similar stock within 30 days and still be able to write off losses. Can you give some examples and how to stay clear of this?
Yeah, you bet. And that you see it even written right here: substantially identical investment within 33s, within 30 days. So what does that mean? Well, first of all, so let's talk about the rule, and we'll talk about all the interpretations of the rule. So this is, I talked about maintaining your portfolio. Well, say, and what we're looking at our models right now, we do this every quarter where we go through we look at every position. Should it be there? Should we buy it, sell it? Should we increase exposure? Should we reduce exposure? And is there something else that belongs in this portfolio? So we go through all of those, and we have 15 models or so where we go through line by line. Well, in the course of doing that, we have to make sure we don't trip the wash sale rule, right? So substantially identical. What does that mean? Go get your lawyer, because that can mean anything you want it to mean. So let me, if you do it, so first of all, I'll talk about the rule itself. If you do it, say you have, I'll use QClean and iClean, which are two ETFs out there. Clean energy, one's from one company, another one's from another company. Well, if you switch from QClean to iClean, we'll say that does qualify as a wash sale rule. And you have, say you're 20% down in QClean, so you sell it to take advantage of tax loss harvesting, and then you buy iClean. Well, if you buy that within 30 days, and we were considering in this case, that is a substantially identical, which I think it is. Whatever losses you had in QClean, if you turn around by iClean, you're not going to you're going to get hit with a wash sale rule, right? Or you sell something and buy something back within 30 days, say it's exactly the same. Then all those losses that you had, how it's going to show up on your tax form, your 1099-B, is it's going to say, okay, you lost, say, $2,000 on this, but due to wash sale rule, these don't count. So you'll have like a little W behind it, and that means you can't write that off. So at an extreme, if you're a day trader and you don't go through the paperwork of filing your pattern day trader paper, for tax purposes, if you buy and sell a stock, say you take 2 day trades in one day, you could be up in one trade, down in the other trade. But since it's a wash sale rule violation, you don't get to count the down. You don't get to count the losses. So at the end of the day, you're even, but you owe taxes on the gain that you didn't get to keep. So you can end up running up a tax bill on yourself for something you actually didn't make. But to you and how most of us run a portfolio, you just have to watch that if you sell something at a loss, you have to wait 30 days to buy it back, and you can't purchase, substantially identical. So where you will see this for most people, where you will see it is if you reinvest dividends, and that's a story for another day. I generally don't, because I actively manage a portfolio. So I always like having dividends go into cash so I can target them appropriately. If you're a hands-off passive investor, set the dividends to reinvest. If you're not going to look at it anyway, the money might as well be going back to work for you, right? But if you do dividend reinvesting, say on a quarterly or monthly basis, depending on when they come in, and you turn around and sell something, you will, at a loss, that last dividend that you just got, that you turned around and bought, and now you sell, within 30 days of reinvesting that dividend, you can get these little W's all over the place on your tax form. And it won't be a huge impact on your tax bill, but you will see it on there. And if you're wondering where that's coming from, you're like, no, I didn't. I made sure to stay very clear of this wash sale rule, but then yet you get hit on it a little bit just because of those shares that were reinvested. So anyhow, something for you to watch out for. Now, Investopedia, which is not a qualified investing site run by FINRA or anything, it's the Wikipedia of investing. It says clearly that you can use ETFs to get around the wash sale rule. So you can sell one, it's an example right here they use, and I don't know that I agree with this. Actually, I think I disagree with this. If you sell one S&P index fund at a loss, you can buy a different one buy a different one. I throw the BS flag on that. Like the Q Clean and I Clean, they're the same thing. I mean, you can get in there and there's going to be a small positional differences within those, but substantially identical. I mean, come on, bro. Yeah, it is. So anyhow, so we're going to steer clear of that anyway. But in this case, Investopedia says it's okay. I'm not sure the IRS would agree with that because of it is substantially identical. So that's kind of all I have on that. As you navigate this, if you don't do a lot of buying and selling in your portfolio, you really don't run into this a lot. If you do tax loss harvesting in December, just kind of wait till past if you do it today, wait till January 15th to start doing a lot of major moves in your portfolio next year, and you're going to stay well clear of this. But honestly, in enforcement, and I don't want to the rules are the rules. You need to follow the rules. That's period. That's the message. However, as far as who's going to know, or is the IRS looking at your tax forms to determine this? The custodians have a responsibility to where if they see a wash sale rule violation, they will flag it and put it on your tax form. Outside of that, if they don't flag it, you're right. You're supposed to flag it on your own, or and report that to the IRS, or the IRS is could come after you and look at all these stock trades. I have not heard of any situation where that would ever happen, right? But just be aware that the rules out there. Do your best to stay clear of it, and you'll be fine.
Thank you, everyone, for your questions. Please submit your questions as a comment through social media or directly to our email at vipservices@ankerstarwealth.com. And don't forget to like and subscribe to get daily updates. That's all we have for today's show. I'm Allison Ankerstar, and we'll see you back here tomorrow.